Hello students and welcome to Legacy IAS. In this lecture, we will be understanding about surety bonds. We'll be seeing what these surety bonds are and why they are in news right now and everything related with them. Okay, so let's get started. What is the news about them? So basically the IRDA, that is the Insurance Regulatory and Development Authority of India, IRDAI, has formed a task force for addressing the challenges in the surety bonds insurance as well as to drive the growth of the surety bond insurance. So surety bond insurance is a particular sector in which there are certain challenges. To address them, a task force has been formed, and the other objective of the task force is also not just to address the issues but also to drive the growth in the surety bonds market. All right, having said that, let us look at what surety bonds actually are. So let's understand with the help of an example. Okay, so for example, there are three parties, let's say X, Y and Z. Now party X is, let's say, a contractor. For example, you have construction companies like L&T, which is nothing but a contractor company. So let's take an example of L&T. This is just for understanding purposes, not a real-time example or real-life example. So let's say L&T is a contractor who is obliged, who wants to undertake a project. That project is being given by Y. Let's say this is a government entity who has given L&T the project. Okay, now they have given L&T the project to carry out an infrastructure project, and L&T in turn has accepted it. Now the issue is that there are certain risks associated with this project, right? Now the government may think, if I keep giving money to L&T, whether they will do it or not. So this kind of risk is present. Whether this company, now L&T is a big company, so let me take a different example. Let's just say there is a contractor, right? There is a contractor who has been given this work. Now this government does not know whether this contractor would do the work or not. And also, you do not give the money initially only. The contractor should have some capital of their own to put in the project so as to do it. Now, all these issues will be there, all these risks the government would be worrying about. So the government would then ask the contractor that, boss, you give me a bank guarantee. Bank guarantee is a different concept. We'll come to that later. Or the government can ask for a bank guarantee, or they can ask for a surety bond. Surety bond. So now from where will the contractor get the surety bond? From this financial institution, that is Z. Z will provide the surety bond to the contractor, which the contractor will then take to the government and show that, see, I have a surety bond from this financial institute. So what is a surety bond? Surety bond is just a piece of paper which a financial institution is giving to the contractor, which the contractor then show the government. So what is it actually? It is saying that Z is saying that contractor to whom you have given the work, I am giving the surety that that contractor will carry out that work properly, right? So now what are the benefits involved for these three in this? First thing, the contractor obliges with the government's requirement. So requirement is fulfilled. What is the benefit of the government? The government is now sure that the project will undergo because someone has taken the responsibility. What is the benefit of the financial institution? The benefit is that when the contractor will get the surety bond from the financial institution after paying some amount, some money. Let's say if you are asking about a surety of 100 crores, maybe 1 crore was paid to the financial institution. So the financial institution gets the money, government gets the surety, contractor gets the contract. So this is how surety bond works. But the financial institution is getting the money. At the same time, the financial institution is also getting the risk, because if the contractor is not able to perform the task which they have promised, then this financial institution will have to pay that 100 crore which we talked about to the government. So the risk is now for the financial institution. And whose risk was that initially? Initially it was the risk of the government and the contractor. So basically the government and contractors risk, or the government risk if the job does not get performed, has been now transferred to the financial institution by the contractor by paying some amount of money. So that is nothing but surety bond, wherein a financial institution gives a surety to, let's say, a government organization that a particular contractor will perform the particular task. This is how surety bond works. That is why this is a tripartite agreement. Tripartite agreement means three parties are involved in this particular agreement. So this is what surety bonds are all about. These three people whom we talked about are principal. Contractor would be your principal, government would get the surety, so they are the surety, and surety bond institution, financial institutions who give the surety bond are the obligee. So let us understand them in detail. The principal is nothing but the party that purchases the bond. So remember, the contractor purchased the bond from the financial institute, so purchaser of the bond is the principal who will be purchasing the bond. Surety. Now the insurance company, surety is actually the insurance company or surety company that would guarantee. So surety would be this. This X is the contractor, surety is Z. Z is the surety and government would be the obligee. Okay, so surety is the insurance company or the surety company that guarantees the obligation or the task will be performed. And then you have the obligee, the party who requires the surety. Who required the surety? The government. So the government becomes the obligee here because they are the party that requires and often receive the benefit of the surety bond. They will be the one who will be receiving the benefit of the surety bond. If the contractor is not able to perform the task, the financial institution will give that particular amount to the government who is the obligee. I hope that is absolutely clear. Let's look further into surety bonds. Of course, as we understood, provided by the insurance company on behalf of the contractor. The contractor is not able to give surety. So that is why the contractor is buying the surety, and this surety is being provided by the insurance company to the contractor for the project that is being awarded to them. Of course, it will help what? It will help in mitigation of risk, and it will give the confidence to the person or to the government or to the organization that is giving the project to the contractor. And of course, it takes away the dependency on the bank guarantee. Bank guarantee is also a similar concept. Bank guarantee is generally what? If I give a project to a particular organization, I will not initially only pay the organization. The organization needs to start the work on their own first. So they need to have some amount with them. Now they may not have complete amount with them, but they can give me a bank guarantee, wherein the bank is pledging that even though this organization, this contractor does not have complete 100 crores, and has only 10 crores, but if they need, I will be providing it to them. So that is a bank guarantee, and hence the project can then start. So similar to bank guarantee is the surety bond. So if you are using surety bond, there will be no use for bank guarantee. Now, what is the objective of the surety bond? It is very clear. Of course, it is mainly aimed at infrastructure development projects, but it is very clear that it is to mitigate the risk, reduce the indirect cost of suppliers and work contractors is another, let's say, objective. So it reduces the risk. Also, what happens is the suppliers, the work contractors, this business, this infrastructure development projects, it happens a lot in credit as well. For example, steel is being supplied, then the payment happens later on, right? After the testing is done, this is done, it has already been supplied, and it takes weeks and months at times because the project itself is of a longer duration of years and years. That is why credit and risk mitigation needs to be there, which is helped by the surety bonds. Now, what are the benefits of these surety bonds? Surety bonds, basically, they are protecting the beneficiary against any risk, against any acts or events that impair the underlying obligations. See, when the let's say surety bonds are not there, the government gives a project to a contractor. The contractor is not able to do. Now the project is delayed. Delay itself is a cost to the government, to the company, to the government, to everyone. Now, because there is a loss, now the government cannot recover that money, right? Or whoever has given the contract cannot recover that money because there was no surety. Now, if there is a presence of surety bond, then what happens if the contractor is not able to implement the obligation, then the government need not worry because they'll get the money from the surety bond, right? So it protects the beneficiary against anything which may stop the contractor from standing up their side of the bargain. So it is basically the guarantee of performance. It is a guarantee that this act will be performed. If not, you will get this money. Okay, so it is basically a guarantee. But then there are some issues with it. What are the issues? The issue is that it is a new concept and it is a risky concept, and our insurance companies do not have this particular expertise in this particular risk management. They have insurance, health insurance, life insurance, accident insurance, but with respect to infrastructure development projects, with respect to surety bonds, the expertise and the experience is still not there, because of which we do not have clarity on pricing. If I am giving a surety bond of 100 crores, how much I charge? How much should I charge? 1 crore, 2 crore, 10 crore, how much? Because there is no predecessing data also. Now, once we start doing it and when we have a 10, 20, 30, 40, 50 years data, then it will keep refining and getting better and better, right? At the same time, the surety bonds need extensive reinsurance. Now, what is reinsurance? Reinsurance means when an insurance company provides surety bond, they themselves get themselves insured by another insurance company for all the surety bonds that they are providing. That is known as reinsurance, which is required in this case, which is again not present comprehensively in India for surety bonds, right? Now, the issuer of surety bonds in India should be in a position to legally enforce tripartite contract. Enforcing tripartite contract becomes more difficult. See, when there are two people involved, there is a contract. It is anyhow difficult, two people conflicting in nature. When a third person or an entity comes in, now there can be more conflict. When two people are there, they have to agree on certain things. When three people are there, now three people have to agree on certain things. That becomes difficult. Plus, what can happen is, let's say X, Y and Z are there. This person is saying A, this person is also saying A, but this person says B. So there is a conflict. This person says B, this person, So understand, there will be a lot of permutation and combination involved over here. Now this person says C, this person says C, but this person says D. Right? So what is happening? These two may say something, this person may say a different thing. These two may say something, this would say another thing. This person says T, this person says T, this person says S. So these two may say something, this person may say something else. So there are three different possibilities have arisen. So it is very difficult to implement the tripartite agreement, and also their legalities, the complexities are also very much over there in this contract. So Indian contract, and in another drawback is Indian Contract Act and Insolvency and Bankruptcy Code Act, they do not treat insurers on par with investors. Meaning what? Meaning if a company is bankrupt and their assets are being sold, the investors would get the money first, insurers will get later. If any money is left, only then they will get it, because they are not at par with investors, right? So these are the challenges which are there, and IRDAI has formed the committee specifically for the reason of addressing the challenge and to drive the growth of the surety bonds in the coming years. Thank you.